Hello.
Hello.
Oh, good evening, sir.
Good evening, sir.
Yes, sir. I'm waiting for Mr. Taylor to join us before I start.
Yes, let's wait till some minutes. Okay.
Okay.
Yeah, in case I'm unreachable, I'm actually want to attend something, but just wait for some minutes. Then I'll make you our co-host so you can accept students, and you can unmute yourself at any time.
Okay.
Okay, sir.
Just have fun, make new friends, and connect. Because what I do is I.
Okay. So good evening, Mr. Oluwaseun Emmanuel. It's nice having you back online after several days. So basically, we'll continue from where we stopped in our last class concerning accounting, financial performance, and statement of financial position. Then from there, we look at a question and we can go into cash flow. So if you can hear me, I don't know if you can put up a message to say you can actually hear me. So if you can hear me, just put up a message on the chat that you can hear me so I can continue the class. Okay, great. All right. So Because today we just have to be fast as possible, and we just need to get this done, because this week is actually your exam week, and we just need to be fast as possible to hit. So let's go straight to questions that talks about financial statement of financial position and profit or loss accounts. I'm aware that additional information adjustment has been treated to you, and this particular question has a lot in it that we can actually look at. So we take you back to a lot of revision that we've done in the past, and from there, if you have any question, you can just let us know as quick as possible. So let's read up this question. The list of balance of Okidagbo, a limited liability company at 30 September 20X9 was as follows. Accumulated profits in 1st October 20X8, ordinary shares, preferred shares, bank overdraft, factory cost and depreciation, office equipment cost and depreciation, delivery vehicles cost and depreciation, inventories, receivables, ledger control account, payable ledger control account, factory wages and overhead, administration, salary, purchases, revenue, distribution cost, and 18.75% loan be payable in 20Y3. Trial balance differences. Now, if you look at it, it has a trial balance differences. It means that even the trial balance is actually not complete. So this trial balance differences is as a result of a suspense account. So they have a 1,063 naira that is yet to make the trial balance complete. If you also look at it, you see that you have a receivable ledger control account, payable ledger control account in your books, which means that there is actually issues with the receivables ledger and payable ledger. And if you also look at it, you see your office equipment that has cost and depreciation. Two figures beside it, we have costs 34,776, and we have depreciation of 18,456. So we have two figures side by side, knowing fully well that this side is the debit and this side is the credit side. So how do we look at this information? How do we treat this information? We have a lot of additional information towards it. Now, the first part of it says that annual depreciation should be charged at 2.5% on the cost of factory, at 15% of written down value of office equipment, and 25% of written down value of delivery vehicles. 2, 3 errors have occurred in recording transaction in sales day book. First is that invoice with a value of 1,427 was posted twice. A credit note of 147 has been treated as an invoice. Credit sales for September totaled 18,421, but have been posted in the revenue account as 18,241. So these are errors. For example, the first one, invoice with a value of 1,427 was posted twice. This is one of the errors that actually affects our trial balance not to balance. So this particular one was actually posted twice, which was supposed to be posted once. So this needs to be adjusted. This needs to be corrected. A credit note also has been treated as an invoice. It is a credit note, and yet we actually treat it as an invoice, as if it's a revenue, as if it's actually a revenue. So this has also been treated as an invoice. We also need to actually deal with it. Credit sales also, that was total 18,421, has been posted to revenue account as 18,241. This is one of an error of transposition to that affects trial balance. Number 3, additional information. A contra between the receivable ledger and the payable ledger account for 43 naira has only been reflected in the receivable ledger control account. So this is a one-sided entry. So a contra, what a contra means simply means that what is in the receivables was supposed to occur in the payables ledger control account. That is, it's like a net of, it's actually netting each other of similar accounts. So this receivables, this amount was actually posted in receivable account, but it wasn't reflected in the payables account. These are the corrections that we make that does not even make the trial balance to even balance in the first place. A preferred dividend of 1,200 was paid on 28 September 20X9 and entered in the cash book but not posted in the general ledger. So they said a dividend of 1,200 was paid in the cash book. It was entered in the cash book, but it was forgotten to be posted in the general ledger. The director proposed an ordinary dividend of 25% of the profit after charging preferred dividend. Inventory at 30 September 20X9 amounted to 29,371 naira. Loan interest is to be accrued for the year ended 20X9. First, prepare a journal entry, including narrative to correct the trial balance differences. You are not required to write up a suspense account. So basically, a suspense account is the account that actually corrects the error that affects trial balance. But here they are telling us that we should only prepare a journal entry, but it's not necessarily that we need to open a suspense account. You are not required to write up a suspense account. 2, prepare the company statement of profit or loss for the year ended 30 September 20X9 and a statement of financial position as at 30th September 20X9 in accordance with International Accounting Standard 1. So far as the information allows. Note to the account is also not required. Ignore taxation, 16 marks. So this is actually about, we have suspense account in this question, errors that affect trial balance in this question. Rather, we have profit or loss, we have control account, we have profit statement of financial position in just single one question, one illustration. So this is more or less like a revision to everything. So a lot of things that we've actually been doing way back, we need to look at. Okay, so without no further ado, let's look at what was the trial balance, the errors affecting trial balance actually really saying. The first one, which is this, the point 2, 3 errors that have occurred in recording transaction in sales day book in September 20X9. The first one was invoice with a value of 1,427 has been posted twice. So we have invoice that has actually been posted twice. Then what do we do? Remember that these are the errors basically that affect, these errors basically are the reason why our trial balance does not balance, this 1063. But then our trial balance is the debit entry. So we need to correct all this error. We just need to correct all this error so that our balance sheet can actually balance. Hence, what do we actually do is that this invoice with a value of 1,427 and be posted twice, does this actual error affect our trial balance not to balance? Because what they're actually telling us is that we've actually debited our purchases and credited our payables. So once you debit your purchases, you debit your payables with the invoice that you received. But this was actually done twice. So in other words, what they're saying is that you debit purchases of 1,427 naira, you credit your accounts payables of 1,427 naira. You now did it twice. So the only thing we just need to do is that, how do we delete the second one that we entered twice? It's just the simple analogy that we are looking at. This type of error is actually error that does not affect trial balance. There are errors, but this error does not really affect our trial balance. So how do we correct it? Then initially, this is what they have actually done. Since they have actually posted the writing, but did it twice, we need to correct the second one that was done. Hence, we had to debit our accounts payables. We had to debit our accounts payables with 1,427 naira and credit our purchases with 1,427 naira. This particular posting will actually delete the second one that we've posted, so leaving it to just one posting. Remember, the proper entry was to debit purchases and you credit accounts payable, but then you did it twice. So we leave the first one and go to the second one that we did again, and we will now have to rewrite it by actually debiting accounts payables and crediting purchases. Hence, this has actually deleted the second posting. Really, it does not affect the trial balance, so there's no point wasting much of our time. In the example, the best thing you just have to do is to ignore this particular question, since it does not really affect our trial balance. Now, let's look at the second one. A credit note of a credit note for 1,407 has been treated as an invoice. So what did they actually do here was that they actually posted this 1,447 as an invoice. Hence, we need to correct this amount. But then, how do we actually correct this 1,147 that was treated as an invoice? It simply means that they've actually debited the purchases and credited the accounts payable. And once you have actually credited the accounts payables and you've debited your purchases of 147, it's actually a credit note. It's actually a credit note that we received. So you shouldn't have been treating this particular invoice, because we are the one actually receiving this credit note. So the best thing to correct this particular amount was that our credit note is actually affecting our sales. And since it is affecting our sales, we are issuing a credit to our customer. In other words, we are telling our customer that, okay, you have an excess of 1,147 naira with us. So in other words, we are actually owing you 147 naira. But the way they treated it was not correct. This particular error was what is affecting our trial balance here. So then, what do we actually do? We actually make a correction to this 1,147 naira by reposting the total correction. So how do we repost this total correction? Does this error, okay, the first thing that you need to actually know is that, does this error actually affect your trial balance? Does this error actually affect this your trial balance not to balance? If it does not actually affect it directly, then the posting does not affect your trial balance. You won't be bringing trial balance into the equation. But if it's actually those errors that affect your trial balance, then your error, when you are correcting it, it will actually be bringing trial balance into the picture. What actually happened here was that your credit note was entered as an invoice. Then what do you have to do is that you just need to re-credit your purchases. You just need to credit your purchases of 147 and debit back your accounts payables of 147. Similar thing you did in this first one is also the similar thing you are going to do in the second one. So it's just an adjustment that really does not affect your trial balance. So how do we know if something affects your trial balance? Basically, if the entry is one-sided, you will know that this entry affects our trial balance. But if it is for both credit and debit, in a question like this, that is talking about our profit or loss or statement of financial position, it's better left that is not affecting our trial balance, it's not affecting our books, it's not affecting our record, so you leave it alone. It's more best that we just ignore the particular question. But the proper correction to this account is that you credit your purchases and you credit your purchases and you debit your account payables. Okay. A credit sales for September totaled 18,421, but have been posted to the revenue account at 18,241. Now, this is also an error. But does this error also affect our trial balance? Is what you first look at. A credit sales for September totaled 18,421, but have been posted to the revenue account as 18,241. This is actually a one-sided account. In other words, they are trying to tell us that they've already debited our credit sales of 18,421, our account receivables or whosoever that is owing us the money. They have already debit the account with the correct figure. But on our revenue account, what they actually entered was 18,241. However, if you look at the difference between these two, you will see that the difference is actually 180 naira between 18,421 minus 18,241. What actually happened here was that we've understated our revenue. Instead of us saying that we make 18,421, we are saying we make 18,241. So how do we correct this? These are the reason why we are having differences in our trial balance in the first place. So we need to correct it. So then how do we correct it? We will say that, okay, we debit our trial balance. We debit our trial balance with 118 naira, and we credit our sales revenue with 180 naira. In other words, so which means that the 180 naira has increased this 18,241 to 18,421. If you look at the illustration example solution 1, you'll see that the difference was TB differences of 118,000 and 180 naira, and we credited the revenue of 180 naira, being transposition error of sales posted to revenue accounts. So this is an error that has now been adjusted. Hence, this particular 180 will now come to this revenue. Take note, to this revenue, because we need to add 180 to this amount here. So by the time you are calling 180, you remember how we got this 180 that we are adding to this revenue in the future. Okay, let's look at another one. It says that a contract between receivable ledgers and payable ledger account for 43 Naira has only been reflected in receivable ledger control account. Excuse me. So if you note, I told you that the error that affects trial balance are mostly one-sided, and the error that does not affect are actually because it's their errors, but it actually affects the two parties, the two sides, both the credit and debit. But the one that affects trial balance always, most times, affects one side account. It's always one-sided error. Okay, so just like this theory illustration says, that it was only reflected in a receivable ledger control account, which means that we actually debited receivable ledger control account. So what do we do to payable ledger control account? We debit our TB differences. Remember, our TB differences is this guy here. We debit it with 43 Naira, and we credit our purchase ledger control account. Oh, sorry. We debit our purchase payable ledger control account with 43 Naira, and we debit our trade trial balance differences with 43 Naira. It's actually a contract between receivables ledger and payable ledger. In other words, money left the receivables ledger to our payable ledger. So payable is the one actually receiving, but then it's only reflected in the receivable ledger control account, but it does not reflect in the payable account. So the reason why we are debiting our payable account and to credit our trial balance difference of 43 Naira, which is what actually happens here. Being contract with receivable omitted from payable ledger control account, 43 Naira. So let's look at the third illustration. I think this is the error, the last error in this illustration. A preferred dividend of 1,200 was paid on 28 September 20X9 and entered into cash book. In other words, it was entered in the cash book because the money left the account, but not posted in the general ledger. But you see, it's also one-sided. So this particular amount will always be affecting our trial balance. So what do we then do? Because the money has left the cash book, we've credited our cash book, then there should be an account that is supposed to be debited. So which is the preferred dividend? Dividend of 1,200 should be debited, and the trial balance should be credited. Note that all these adjustments that we just made here need to reflect in this figure going forward. So this 1,200 has been debited of the dividends of 1,200 and trial balance differences of 1,200. So here you go, your format full, no issue with it. Hence, now let's go to our B, which is really the core calculation of the whole thing. It said, prepare the company statement of financial position, profit or loss account for the year ended 30th September 20X9, and a statement of financial position as at 30th September 20X9 in accordance with IAS 1, so far as the information allows. And they said that note to the account is not required. Also, ignore taxation. Sorry, 1 second, please. Also, ignore taxation. Okay. So, statement of profit or loss position. Revenue, we have 317,394. Is that what we have in our account itself? So in our trial balance, remember our trial balance, we have 371,935. 370,394. Then something must have been done. So what actually happened? Then we move on. Look at it. Look at it. Per trial balance, 371,935. That was the figure of trial balance. Remember the invoice that was posted twice that we talk about. It was posted twice and we had to remove it from our trial balance. The invoice that we had to credit our account, our revenue, and debit our accounts payable. This is it. 1,4, and that we have to credit our revenue and we debit our accounts receivables. 1,427, the invoice that we received. So this is it here. It was actually removed from 371,000. Remember the second entry that was misposted. The second entry of 148,000. If I'm correct. Okay, 147,000 that was misposted because they actually debited the wrong account entirely. What was it again? A credit note for 147 has been treated twice, where they actually, no, was it that one? Sorry, I'm coming. A credit note, okay, not twice, that has been treated as an invoice. It was treated as an invoice. So the figure that was treated as an invoice simply means that they actually credited the accounts receivable, they debited accounts receivables and they credit purchases, they debit purchases and credit accounts payables. Hence, what is actually supposed to happen was that they are supposed to debit purchases, sales, and debit revenue. They are supposed to debit sales and credit account receivables. So credit note was misposted. In other words, what they are trying to tell us here is that 147 as a credit note was treated as an invoice. How was it treated as an invoice in the first place? Was that they debit the account receivables. Listen carefully. They debit the account receivables and they now credit our revenue. That was the way it was treated as an invoice. But then it's a credit note. In other words, we have excess. The money that they pay was more. So in other words, the money was supposed to be going out from our revenue. That is what they are trying to tell us. The money was supposed to be going out from our revenue. But because we initially treated it as an invoice, we have actually increased our sales again. Let me give you an example. I bought goods from you. I bought it for 100 naira. So your own sales was 100 naira. And me that is paying you as an account receivables, is 100 naira. So therefore, you are debiting my account and you are crediting your own revenue account. But then, because this worth of goods that I bought was 100 naira, and I gave you 200 naira, meaning that I'm owing you how much? You are owing me 100 naira change. and you're supposed to give me 100 naira. But because you don't have 100 naira change, what did you do? You are supposed to write me a credit note of 100 naira to me, telling me that you are owing me 100 naira. So how do you now treat this remaining 100 naira balance of me? So instead of you to remove it from that 200 naira, you enter the 200 naira completely as your sales. So you enter everything as 200 naira. Then how do you remove this 200 naira and convert it back to 100 naira? Therefore, you have to debit your account with 100 naira. But then, that is the original thing that was happening. But then they now said this particular transaction, you now treated it again as an invoice. So after you've entered the 200 naira revenue that I gave, because I gave you 200 naira, you've entered it. So the fact that you are now giving me a credit memo, telling me that you are supposed to debit my own account, and telling me that you are supposed to debit your revenue account and you credit my own account, meaning that you are now still owing me 100 naira. What you now then do was that you now debit my own account again with 100 naira and you credit your own account again with 100 naira. So making 300 naira that you now have. Or maybe I'm using too much 100 naira, so you might not understand. So let me use 150 and maybe 50 naira. So you understand the 100 naira from the 50 naira. So I bought 100 naira worth of goods from you, but I gave you 150 naira. So what you did was that you enter the 150 naira as your revenue. You credit your revenue. You debit my own account receivables or cash. But then the 50 naira change you were supposed to give me because it is not your money. What did you now do? You wrote a credit memo telling me that you are owing me 15 naira. Maybe in the future when I want to buy goods, I will not pay extra 15 naira. So after you've done the credit memo, you were supposed to enter that 15 naira back. But how did you now enter it? Normally, you are supposed to debit your revenue account because you've actually entered it before as 150. So you are supposed to debit it as 15 naira. But you now again went ahead to go and mistakenly entered it as income, revenue. You credit it with 15 naira again. Remember, you've initially credited that 150. And the 15 is only 100 naira that is your money. And when you now saw credit memo again, you now enter the 15 naira again, making 200 naira in your revenue. So it means that goods of 100 naira, you are now having 200 naira. So you need to reduce that 15 naira. Remember, my change going where it's 15 naira, but you are having 100 naira in your own books, SS. So you need to reduce it back to 100 naira. Because you have had 150 plus additional 15 naira, making 200 naira. So you need to reduce this figure back to 100 naira. So what do you then do? Is that you have to debit your revenue account with 100 naira because you already have 200. So the same thing happens here because this 147 naira is already in their revenue account, which is not their money because it has also been entered initially. So it's like you now entered it twice. So you need to reduce that money back to the revenue account. So you add this figure together, making 294 naira also. How much is it now? Sorry, 1 second. 294 naira. You have to remove it from your account. That's the reason for this. And the other 180 transaction, if you still remember that we understated this account. So because it was understated, so we need to add additional 180 to it. In other words, I bought goods of 150 naira from you. Instead of you writing 150 naira, you now write 105 naira. So in order to make it back to 150 naira, you can't just cancel. So you are looking for how to enter 45 naira into the account. So you need to add 45 naira to 105 naira to make it 150 naira. So it's the same thing that happens here, 180 naira. So if we add all this together, it gives us 370,394 naira. Simple as that. So then we now have to come here again. Less cost of sales. What is our cost of sales? Our cost of sales as per trial balance. Purchases. What makes up our cost of sales is actually our opening inventory plus our purchases minus our closing inventory. Or what do they call it? Yeah, is it stock? Yeah, okay, inventory. So they call it inventory. Sometimes you might not say inventory, they can call it stock. But basically, according to this new standard, IAS1, so it's known as inventory and not stock. So what is our opening inventory? Our opening inventory here is 31,332. Our purchases is 237,411. Our closing inventory is 29,371. Remember, you add your opening plus your purchases minus your closing inventory. So this is it. Opening plus your purchases, it gives you 268. I don't know if you can see. Okay. 268,743. Your closing inventory of 29,371 less it, you have 239,372 naira. However, we have some wages and we have depreciation. So because of this account, so we look at the nature of this account. It says that, where is it? Where is our depreciation? It said annual depreciation should be charged to cost of the factory at 2.5. Okay, annual depreciation should be charged at 2.5% on cost of factory, 15% of office equipment, and 25% of value delivery. So we have three types of costs in this place. We have the factory cost, we have the administrative cost, and we have the selling and distribution cost expense. So this cost, there is one that actually affects our cost of sales, there's one that affects our administrative, and there's one that affects our distribution. So for example, what are the costs that affect our our cost? Like wages, not salary, like wages, those money we pay to laborer every day, daily money, it affects our cost because it makes up the part of our cost of production itself. What are the type of things that affect our administrative, like lights, like chair, tables, all those expense that affect the administration, the running of the administration itself, like internet, all those costs. So those are administrative. But what are the administrative that affect our distribution, selling and distribution, like postage, like delivery, all those expense like that? They are the one that affect our distribution. So which one is going to affect our cost of sales? We look at our factory cost and depreciation. We have 40,400 naira, and it says 2.5% is charged on costs. 2.5% is charged on costs. So find the 2.5% of 40,400 naira. It will give you, sorry, okay. 2.5% of 40,400 to give you 1,110 naira. Okay, I think we have wages, we have salary, and I want to clear out some things as to that regards. Okay, so in your question, sometimes you might see factory wages and overhead. If you see factory wages and overhead, it means that it's affecting your cost of sales. If you see wages and salary, it means that it's affecting your administrative expense. If you see wages alone and you see salary alone, the wages is affecting your cost of sales, while the salary is affecting your administrative expense. If they merge the wages and salary together, then it's affecting your administrative expense. But if you see something like overhead wages, factory wages, is affecting your cost of sales. So where they separate it, you should know. But most times it's always together anyway. But for example, in this type of question, you can see that they separate wages from your salaries. So that's why 62,771 will be added to your cost of sales. 62,731. So by the time you add everything together, you have 303,113 naira. This figure is what you are subtracting. Yup. So by the time you subtract it, you have 67,281 naira. Then your distribution costs. So your distribution cost also entails your depreciation and your amount for distribution itself. So what makes up your distribution expense? Here we have your depreciation for delivery van. So delivery van is what you use to distribute your expense. And at what rate do they advise us to depreciate? 25% of written down value. So what is written down value? The written down value of an asset is actually cost minus accumulated depreciation. Cost minus accumulated depreciation. So here we have our delivery vehicles cost at 19,721. What is this depreciation here? This depreciation here is an accumulated depreciation of 4,681. By the time you subtract these two, the answer it gives us is the written down value. In other words, they call it net book value. So by the time you got your answer, you find 25% of that figure. It gives you the depreciation for that year. Do we have any distribution costs? Again, aside from this, let's look at it. Yes, distribution cost of 16,423 naira. These are the two we are just adding together to make up our value. 16,423 naira, 3,716 naira. How did they get 3,000? Remember, this 19,721 minus 4,681, and you find this 25% of it is going to give you this. The addition of these two, 20,183 is what you have here. Remember, you subtract your cost from your gross profit. So what is your administrative expense? Your administrative expense is the expense that actually affects the running of the company itself. Remember, I said the cost factory expense is the one that is attributed to the goods, your cost of production itself. Cost of production is the cost that affects it. Your distribution is maybe cost of how you are distributing your goods after produced. And I gave you several examples like deliveries, like stationery, postage, all those things. So, but administrative expenses, where the guys are sitting to make this decision, where is actually helping them to analyze, do their research and everything. For example, the internet, the light, the building itself, and so on and so forth. So what is the administrative cost from your question? The administrative cost here is 20,844. We also have depreciation that relates to it, office equipment. We have cost and depreciation. Note that during the factory, it only saves 2.5% on cost of factory. That is why we just find 2.5% of this 40,400. But the delivery vehicle, note, it said 25% of written down value. That is why we subtracted 19,721 minus this guy. But then what was our administrative expenses? Our administrative expense says that 15% of written down value of office equipment, the same way we treated delivery vehicle, that's the same way we are treating office equipment. So we are subtracting 34,776 minus 18,456. We are subtracting it and finding 15% of that figure. So that was what actually happened here. So they have 20,000, 2,448. Then by the time these two were added together, it gave us 23,292. And that was how we got 23,292. Then we subtract it. Profit from operation, 23,806 naira. The company went on loan and they charged them interest. Interest is also an expense. It's called, if you don't see it as interest on loan, you can see it as loan interest, or you can see it as finance cost. So basically our understanding is that IAS preferred to be called finance cost. But loan on interest is also not bad. But basically most time you see your question as finance cost. Finance cost simply means that it is interest that is being charged on loan. So what is our finance cost here? The question says that loan interest is to be accrued for the year end 30th September 2023. 18.75% of loan repayable, of how much? 5,250. Is that the actual amount? Yes. 18,304. 18.75% of 5,250 naira. So the figure, it gives us this figure. Then our net profit is 22,822. That's our net profit. You can imagine all this long illustration, all for just how many letters of solution? Shikini solution. Then we move ahead and we go. Statement of financial position. Statement of financial position is where we know where we are as a company, the position, if we are actually making sense or if we are actually not making sense as a profit, as a company. Hence, remember, our factory, our statement of financial position consists of assets, liability, and equity. And remember when we were solving incomplete record, I remember telling you that our asset is equals to liability plus equity. Then we now say that our equity is equals to asset minus liability. So asset minus liability, remember I told you, telling you that asset minus liability is known to be net assets. So in other words, our equity is always equals to our net assets. Back to the assets, we have two types of assets. We have the non-current assets and we have the current asset. Here, if you look at it, they just said we have tangible non-current assets. So even as long as it is non-current assets, we have the tangible and the intangible non-current assets. I could remember in our incomplete record when I was talking about goodwill as an example of an intangible non-current asset. An intangible asset, these are assets that you cannot see. You can only feel it, you cannot touch it. So the typical example of that is our goodwill, patent rights, copyrights, all those things. But basically, that is just too advanced for your level, and we are looking at our non-current assets, which you can see, for example, factory property, office equipment, delivery van. So these are the assets we have. And remember, at cost, this figure are figure from the question, so you can see 40,400, 34,776, and 19,721 for factory property, office equipment, and delivery van vehicles, respectively. It's in the question, you can actually see them. But if you look at the factory and property, depreciation for it, 8,399. Is that what is in our question for depreciation? Let's look at it. For factory, we have 7,389, but this is telling us that we have 8,389. What then happens to the difference? Remember, that the depreciation that was removed when we were calculating our factory costs, when we were, sorry, a second, I think my network just. So remember when we were calculating our factory expense, factory depreciation of 1,010 naira. If you are to add this 1,010 naira to this 7,389, imagine you add 1,010 naira. So you have 8,399 naira. 8,399 naira. That's it. So the additional information from that spot, that depreciation for factory, is what was added in this depreciation. So the same thing also applies. We are adding this, we are adding this, we are adding this to their respective legs. That was what makes up this figure as a whole. Okay. Then the difference between for cost and depreciation gives us this figure. Say 1 second, please. I think I'm here in this one. Okay. So the difference between the cost and depreciation is known as net book value or written down value. So which gives us this amount, 57,153. Inventory. What inventory are we looking at when it comes to current assets? Note is the closing inventory. And the closing inventory that used to appear in your additional information of your trial balance is the closing inventory that we are always looking at. So what is the amount? 29,371, straight up from the question. Illustration A, question 6, additional information 6. Now, trade receivables. Remember that we've adjusted our sales a lot. And remember that our trade receivables was from an incomplete record. Do you know why? Because even from the question, it says that receivable control account. Remember, receivable ledger control account of 27,221. So if you could remember, it's a debit entry, balance as per this. Then remember the invoice that was posted twice. Remember the credit note that was misposted as an invoice of 241. So those things that we adjusted in our sales are the ones that are literally coming back here. Yes, I expect you to ask that what then happens to our 180? Remember, the 180 was just on one-sided. It does not affect the corresponding entry. It is just one-sided leg, which is our revenue that it affects. So that is why we aren't adjusting it in our receivable ledger control account. So by the time you remove 1,427 from and 294 from 27,221, you have 25,500. That was how we arrived at our receivables here. By the time you add your non-current assets and your current assets together, you have 54,871. Add it to your non-current assets, you have 112,024 naira. Bam. Then you look at your equity and your liability. So let's look at our equity. Equity most time is always straightforward. So let's look at it. Ordinary shares, 20,000. Preferred shares, 20,000. Remember, those figures are from the question 20,000, 20,000. So we have an accumulated profit of 18,331. An accumulated profit of 18,331. Which is more or less like, if you, sometimes you might not see it as accumulated profit. You might also see it as retained earnings. They means the same thing. It means that all this profit that has been accumulating all over the years. Excuse me. But then there has been some adjustments lately. Is it from the one that affect our trial balance, or from the one that does not even affect our trial balance? Is it from the one that even affect our sales? Remember that when you increase your sales, it means that your profits increase. If you sell more, of course, you earn more. And if you reduce your sales, it means that your profits reduce. There are some cases whereby we've actually reduced figure from our sales being due to misposting figures, due to transaction posted twice, and also there are some instances whereby we've actually reduced our profits due to the fact that we've reduced the figure that enters into our revenue. So these are things that actually comes into play. Is it just that alone from this question? No, we have even dividend issues. Remember that dividends was shared and it wasn't reflected in the books. It affected our profit and everything because the dividend was removed from the profit. So let's look at it. So from our, where is it? Sorry, accumulated profit, 13,831 plus 22,822. Where did we see this 22,000? Remember our POL. It's coming down here. So we are adding it. That's the profit for the year. Minus 1,002. What? Where does this 1,002 comes from? The 1,002 of the dividends. Remember, there's a place they say before dividend was paid on this and entered into the cash, but was not posted. So dividend is always being removed. It's always reflected from our profits. So it is either you post dividend as a whole or you remove it from your profits. But then what have we done? We've actually credited a cash book. But because our profits is actually a credit entry ledger account, then we will have to debit our accumulated profits of how much? 1,200. So that was why we are removing 1,200 from here. And then we also have 5,460 naira. So where does that come from? Remember our revenue that we've actually inflated loco. Like we've inflated it too much. Let's go and look at the 5,000 figure, where it was actually coming from. Oh, sorry, 5,000, I'm coming, 5,406 naira. Let's look at the information. This has been the tweets, So remember our revenue that was posted twice. This figure, if you add these two figures together, this is going to give us 1,700 and so it's not 1,000. I'm coming over 1,721 naira. So if you are to remove 1,721 naira from 180, it's going to give you 1,541 naira. 1,541 naira. But then this figure won't actually be affecting our revenue, because since we have actually adjusted it in our revenue in the first place, so there's no point actually adjusting it from our profit. Actually, there's no need for that. But if you come here, you will see the director proposed 25% of profits after charging preferred dividend. So after we charge preferred dividend, what is our preferred dividend? Our preferred dividend is actually 1,002. Remember the 1,002 that comes into the question here. This 1,002. After we've removed it from our profit, once we remove it, remove 1,002 from 22,822. It's going to give you, by the time you remove the two figures together, then find 25% of it. The 25% of it will give you 5,406 naira. So by the time we add 13 plus 22 minus 12, 1,200 minus 5,406 naira is going to give you 30,047. At the end of the day, you have capital and reserve of 70,447 naira. So you have a non-current asset. What's your non-current asset? Remember the loan you collected. Sorry. Remember the loan you actually collected. So you collected a loan of 5,250 naira. From your question, you will see the loan. 5,250 naira is a non-current liability. Then you have your trade payables. Remember the trade payables that we forgot to enter when we actually credited our receivables, but we forgot to enter it in our payable ledger control account. That was the 43. Now we are removing from 19,000, which gives us this figure. Oh, yeah, the dividend payable that I was talking about, 25%, because we are still paying this amount. So this is the amount we are actually paying, 4,406 naira, which is this. Accrued expense, interest. Remember the accrued expense of 984 naira that we accrued for. The finance cost. The finance cost. Because remember, what does your question say? The question says that we should accrue notes. Oh, sorry. Okay. Payable. Where does this says it should be? So because the question didn't even specify that we paid this amount, so basically that was the reason why we are actually accruing it to 984 naira. And I'll give you one hint. Bank overdraft of this is also in the question. So by the time you had it, by the time you had everything, you have 36,727 naira. And by the time you add this to your 70 to 55,250, you have 112,024, which is balanced to this. Hint that for every additional information should be treated twice. Every additional information should be treated twice. Okay, now let's start with an example. The annual depreciation, remember, it was treated both, where is it again? Annual depreciation was treated both here. Here, can you see? Our annual depreciation, and it was also treated here. So you treat every of your example, of your additional information twice. For example, your closing inventory. If you look at it, inventory as at this, it was treated here in part of our cost to sales. And it was also treated here also. So likewise, every additional information should be treated twice. 25%, for example, the 25%, where is it again? The 25% was treated here as this, and it was also treated here. So note that your additional information solution is not completed until it is being treated twice in your books. And that is where we end the statement of financial position and profit or loss account. I understand that your exam is fast paced, and I am still surprised that I haven't seen questions so far. So I still want to believe that you understand most of the things that I've been explaining, or probably you've been meeting my other colleagues to explain to you. Either ways, I wish you success. Hence, after this, we look at cash flow. Cash flow is also a very important topic. Cash flow, IS7, is actually a very important topic, as long as financial accounting is very concerned. So basically, cash flow is, the essence of cash flow is that we want to know how money is coming in and how it's going out. Like your cash, how is money coming in and going out? No, there are actually some expenses that there are expenses you don't spend your money on. And there are some that you actually spend your money on. For example, depreciation is an example of an expense, but you don't spend your money on it. Hence, it does not involve your cash movement. Like you're not spending cash to go on it. There are sometimes you actually spend money for like 3 months in one day, and you started accruing for those money each month. For example, you pay 3 months rent of 30,000, which means that each month is 10,000 naira. So because you paid 3 months on your first month for 30,000 naira, so your cash flow, what's left to your cash as at that month is 30,000 naira. But your books, it will be showing as an expense of 10,000 naira because you already know that the following month you record the 10,000 naira and you record another 10,000 naira for the third month. Hence, we want to know the actual movement of cash at a particular period of time. So there are so many methods of knowing this. So there are 3 activities that will determine the movement of your cash flow. 3 separate activities. Is it the one that you spend on your daily, day-to-day expense? Is it the one that you actually spend like a one-off, maybe you bought an asset? Do you understand? Or is it the one that maybe you increase your capital, you increase your shares in the company, or you make a lot of profit, so you want to increase, you want to increase the share capital of your company that people might buy? So those are the 3 activities that is likely going to happen when cash flow is involved. But the one that gives main concern and main challenge is the very first one that involves the daily expense. Because how do you track it? How do you know the one that goes out and the one that you actually do not spend money on? Okay, let me give you an example. You bought goods that you did not pay. Or maybe today, your bank account is showing 15 naira. Oh, sorry, not bank account. Maybe today I am owing you 15 naira. Tomorrow, they now ask you that, at the end of tomorrow, they now ask you that, how much am I owing you? You now said it's 17 naira. That means I've come to buy another additional 20 naira worth of goods between that today and tomorrow. Do you understand? So does this actually involve you spending your money? Does it actually involve that you actually spend your money? If you look at it, you also buy goods, won't you? Won't you buy goods to sell to other people? The fact that I did not pay doesn't stop you from buying your goods so that you sell to other people. Yes, you've actually spent more money because I did not give you money. Another example, another way to look at it is that someone is owing you, you are owing someone 15 naira today, and by the end of tomorrow, they ask you that how much are you owing the person? It has now turned to 30 naira. It means that you settle 20 naira worth of from the amount you are owing. And if you have done that, it means that you have actually paid 20 naira. Money has gone out. So there are several ways to look at this implication to it. So I will just advise, because of time is being fast spent, I will just advise us to, read up all these activities that, like I said, we have several. We have methods also. We have the direct method and the indirect method. Mostly, it's always examinable that they test indirect method. So we are going to look at the 2 fast and possible. I will advise you that you just need to read the written aspect up, and we understand what makes up the cash flow. So basically, the operating activities, if you look at the operating activities is the day-to-day running of the business. The investing is when you buy an asset. I don't know if you could recall, you bought an asset and you want to know, did you sell an asset? Did you buy it? Which one is increasing? Which one is decreasing? And the financing activities, did you borrow money? Did you actually increase your capital, your share capital, and so on and so forth? So these are the activities that you look at to know your cash flow. In direct and indirect method, the investing and financing activities are actually the same. The only difference is their operating activities. Somewhere here, operating activities is actually explained. Cash flow from operating activities can be presented by using direct or indirect. The direct method is cash received, cash paid, you just know if cash is going out or not. So the direct is just so direct because it will be expressly stated. But the indirect is where we now have to compare two periods together, the closing period of a previous year and the closing period of the current year to know what has actually happened. So let's look for a tough question, an examinable question. Let's look at, oh boy. Okay. So some of this question does not have solution, and I didn't put solution to some of these questions, so we have to solve it by following the tasks involved here. Okay, so for cash flow, let's look at the financial question 3, for example. The statement of financial position of AG as at 31 March are given below. Property, plant and equipment, development expenditure. If you can see, we have 2 different years. We have year for 2004 and 2005. So we have current assets, we have equity, share capital, we have non-current assets and liability, we have current liability. So I'm trying to look for one, if there's anyone that has solutions, so you can come along to understand. But since there is none, okay. So let's just, the statement of financial position is this and one. Okay, so to the statement of profit or loss for the year, this is the profit or loss for the year, and additional information. April 1st, AG issued 1.4 million 0.5 ordinary share capital. On May 2004, AG purchased and canceled all its 10% loans per share. Non-current tangible assets include property, which were revalued upward by 125. Non-current assets. Okay, sorry, can you just give me a second? Let me, because I'm looking for a way that you still keep up with understanding what I will explain with this question. So I'm coming, just give me a few seconds. Okay. Okay. Just a few seconds. Okay. So okay, so I think I found a question that can easily be solved and we move on. So the financial position, the financial statement of Onam Manufacturing Limited are given below. We have revenue, cost of sales, gross profit, distribution cost, administrative expense, operating profit, cost, finance costs, profit before tax, tax and profit for the year. So we have for 2017 and 2016 respectively, and we have the statement of financial position. So this is an examinable question. In fact, this is a past question for foundation on cash flow. So we have the financial position. We look at it. We also even have the movement of property, plant, and machinery, how they arrive at 4,302. 4,302. How they arrive at it from beginning, from January, and how they actually from 5,800 and 5,000 from 5,586 to 4,302. See, so and we have additional information. We have trade payable. Excuse me. We have trade payable, add a credit store for plant purchase. Prepare the statement of cash flow for the year ended 20 marks using indirect method. So mostly this question is to come with indirect question. So the first thing we need to look at is the profit for the year. That's just the first thing. Because we are preparing for December 31st, 2007, we pick up the profit for the year of 1,140. Excuse me, 140,000 naira. 140,000 naira, which if we switch back to our solution, we can see that what they pick is actually profit before tax of 280,000 naira. So there are two ways to it. Is either you're starting from profit before tax or from profit for the year. Now, if you are starting from profit for the year and there's actually tax in it, then you are going to be adding back your tax figure. You are going to be adding back your tax figure because basically we haven't paid the tax. We didn't pay for the tax. Sorry, I can't see charts. Oh, shoot. Yeah, you're not seeing my screen. Whoa. Oh, okay, sorry. Yes. Yes. This is the screen that is showing. Share. Can you see my screen now? Can you see my screen now? Okay, let me stop the share and let me start over again. Share screen. Okay, can you see my screen now? Oops. Has to change. How about now? Okay. You can try to leave and rejoin. While I even try to charge my phone. Okay, I'll be waiting. Okay, can you see my screen now? I hope you can. Oh, great. Okay, but so possibly is network. Probably network, so you just need to be fast about it. Okay, so I just want to, can you see the other screen, like the solution aspect also? Can you see moving up and down? I just want to be sure if you can see that also. Oh, great. Okay. All right. So, like I was saying, that the profit for the year was 114 naira, and I said you can actually pick the 114 naira, but note that if you are picking it, you'll be adding back your tax, because basically you're adding. Okay, basically you're adding back your tax because you're actually not paying it. You know, expenses is what you have incurred that you have paid on. But there are some expenses that you actually have not paid your money on. So because you have not actually paid them, and you've incurred them as your profit, it's actually telling us that it has reduced your profit. So for example, this tax, this 140,000 is actually next year. That is when you're actually going to be paying it. So you're not paying it currently. So basically, it is best advisable you pick profit before tax of 280. But then if you are picking your profits for the year, then you'll be adding back your tax if there is any. So 140 plus 140 makes it 280, which is where this 280 started from. Now, finance charge, depreciation, finance cost of 559,000. What was the news about finance costs? Do you have any news concerning it? He said, including the trade payable is accrued interest of 37,000 in this, and we have 18,000. So do we have finance costs in our balance sheet? If we are to look at it. So because we actually don't have finance costs, so hence this money was actually accrued for. Mostly they are actually always accrued interests. So finance cost is always accrued, which does not even involve the movement of your cash, because it's actually an interest that you are going to pay for later, not as if they actually paid them. So that is why you are actually also adding it back. For example, we also have your depreciation. What is our depreciation? Does our question state anything concerning depreciation? In the year, plant costing 466 with accumulated depreciation of 335,000 was disposed of, including trade payable. Okay. So we have depreciation charged for the year. How much is our total depreciation? Well, 894 naira. So this amount, we actually did not spend it. Hence, we also minus it because it's what makes up our administrative cost here. So because we've also added that makes it to reduce our profit, we actually add it back, 894. Also, there was a place that says disposal. Inside this disposal, they said plant costing this amount, 385 depreciation, was disposed of as what? It's 186,000 for 186,000. So by the time you minus these two together, what is it going to give us? 466,000 minus 335. 466 minus 38. Sorry, 1 second. Minus 335. So we have 131. And we have 131. 131, but we sold it off for 186. So 131 minus 186. I think, why am I even pressing my calculator when the calculation can actually be here? Sorry. Okay, so they didn't make notes for that. So if you look at it, 131, that 131 that we got, where is it again? Was disposed of for 186. But then what is the cost of it? This particular amount, 466, with accumulated depreciation of 335. Once you minus it, the total worth of that asset is 131. And 131, you now sold it for 186. Then you are making profit of how much? Additional disposal profit of 55 naira profits. So these are the profit, these are the amounts that makes up your profit in the first place. This 55 naira profit is what makes up this profit. So we have to remove that 55 naira. Oops, sorry. We have to remove that 55 naira. Profit on sales of machinery, 55 naira. So by the time you add these three together, it gives you 1,398. Note, at the end of all these workings, the only way you will know your answer is that the cash that is going to be at the end of your cash flow must be equals to the cash at the end of your cash, of the cash and cash equivalent of 84. Should be at the end of 84, the cash and cash equivalent of 84,000. So you have disposal on profit on disposal rather. So because it is profit and this amount actually does not as make up of your profit for the year, so we remove it. Hence, this particular amount was supposed to be added, included in your investing activities, but we will still come back there later. We'll come back to that part later. So the difference between everything is 138. Also, in your operating activities, we have movement in working capital. There are three types of movements we can actually look at: the inventory, the receivables, and the payables. Again, the inventories, the receivables, and the payables. So what is the inventory? Now, if there is an increase in inventory, an increase in trade receivables, you reduce it from your profit, you minus. If there is a decrease in inventory and there is a decrease in receivables, you add. It means cash coming. And if there is actually an increase in trade payables, you add. If there is a decrease in trade payables, you reduce, you less. Maybe I take that again. So it's actually a keyword and you need to understand very well. If the previous year, the difference between the previous year inventory or receivables is more than the current year inventory or receivables, the difference between the two, you what? You reduce it, you add it. If 2018 figure is more than 2019 figure, the difference between them, as long as they are for trade receivables or inventory, you add it. But if 2018 figure is less than 2019 figure and they are for inventory or trade receivables, you less it. Let's go back to the question here. For example, you have inventory of 207 and you have inventory of 358. You can see that 2017 increased more than 2016. So the difference between the two, the answer, you less it from your profit. What does this tell is that at the end of the year, 2016, you have 207. At the end of 2017, you have 358. What does it mean? You have actually spent money to buy additional inventory. So because the money is going out, whenever the money is going out, you minus. Whenever the money is coming in, you add. It's as simple as that. So for example, if it is the other way around, like we have 358 here and we have 207 here, it means that you have 358 in 2016 and you now have 207. You sold more inventory. Money has come in. That is why we are adding. So that's why I said if there is an increase in your current asset, then you less. And if there is a decrease, you add. Vice versa is what happens in your liability. If there is an increase in your liability, you add. If there's a decrease in your liability, you less. So for this case, you have 207 and 358. So this is an increase, you less. So that was why we are lessing 151. For your trade receivables, you have 223 and you have 335. It's also an increase. The difference between the two, you less. You ask me, why are we not touching cash and cash equivalents? Cash and cash equivalents is because that is what we are defining. That is what we want to determine. How we spend from 112 to 84. So we won't be touching our cash and cash equivalents. So basically, like I said, the working capital movements involve inventory, trade receivables, and trade payables. Now let's come to our trade payables. You have trade payables of 67 and 117. This is an increase. It means that you are owing someone 67 naira, and later you now owe someone 117. It means that you've collected more money. More money has come into your money. So because it is an increase, you had the difference. At the end of the day, whatsoever the difference is, you calculate it alongside the figure you've gotten here. So you have total cash flow of operating activities to be 1,428. It still remains the interest paid and the tax paid. Now, for your interest, if you look at it here, the opening balance of your interest is 18 naira. And how do you know? How can you get the 18 naira? Where's your interest? Is there any additional information? Is there any additional information to your interest? Where is it? Hold on 1 second. I'm looking for where the interest is. $297. Okay, the trade payable had a creditor purchase of 18,000 naira. So this is it. Charge for the year. How much did they charge for the year? 559. 559. So 559 plus this 18,000 naira is 577 naira. Then how much did we pay during the year? Charge for the year, 559. How much did we pay during the, I'm coming, sorry, 1 second. Where is it again now? 559. That is the amount we cost in the year, 559. So that was it. And by the time we add the two together, we have 577 naira. Pay during the year is 540. How do we know it is 540? How do you know it is 540? Coming to 438 No, 438 minus 838. Oh, 1,676 minus 670. Sorry, 838 minus 438. That is 400. Am I right? And how do we got our charge for the year? Is there any paid during the year? 514 there. Sorry, I'm looking because we didn't read the question fully because I'm exhausted. So that's the reason. Why I'm looking for where we got the figure. So this is our PP, this is our trade assets, profits, and 400, and our tax 540. And so events, the trade, including, oh, okay. I didn't see this. So here, included in our trade payable is accrued interest of 37,000. Accrued interest of 37,000, 18,000 in 2016. So this has actually increased. Our trade payable, where is our trade payable? Our trade payable is 18,000, but at the end of the day, we have 37,000 as our closing balance. So remember this 18,000 as our opening balance. Charge for the year is 559. Do you still remember the 559? This 559 that we are adding our finance cost for the year. So it makes up 577,000. But then how much did we pay during the year? We don't know. But the question now later told us that at the end of the year, we have 37,000. So since we have 37,000 at the end of the year, the difference between this 37,000 and this 557 is what makes up paid during the year. Again, it says that included in trade payable is accrued interest of 37,000. Out of this 37,000, it says that 18,000 is in 2016. So when we have 18,000 in 2016, and we calculated our finance cost, accrued finance cost in our profit or loss account, we have 559. So we add our 559 to 18,000. We have 577. The question told us that at the end of the year, we have 37 accrued pay interest left. It means that the difference between 577 and 37 is the amount we actually paid, which is 514 naira. So this 514 naira is what we are actually lessening in our interest paid. The same thing also implies with our tax. Our tax is telling us that in 2016, we have 151. If you look at it in 2016, we have 151. At the end of the year, we have 140. But then 151 plus during the year, what is our during the year? 140. Do you still remember this 140? Yes. 151 plus 140, we have 291. At the year, we still have 140. So how much tax have we paid? 151. So that is why we are lessing 151 again from it, because money that goes out we less, money that comes in we had. So that was the reason why we are treating this. So we have our net cash flow operating activities for 737. Now, proceeds from sales of PPE. Remember that we are lessing how much? 55. Remember that we less profit on proceeds, sales of machinery of 55 naira. I just want it to be at the back of your mind, because the reason why we are lessening it is because we are adding the whole amount that we sold. 186. Remember, 186. Because we did not just add the cost alone, we are adding it including the profit of 55. That's why we had to remove it from the profit initially. So to bring it down here. So 186,000, we are adding it back because it's actually money that comes in. We collected the money. Cash paid for purchases. Now, let's look at it. Did you buy any assets? So in the beginning, we have this 586. We have addition of 2,701. It means that we paid for additional assets. So we bought additional assets, meaning money goes out. And when money goes out, you are minusing. So you are spending your money. 2,701 naira. What then happens? Because there is actually something that happened. The trade payable had a creditor for plant purchases of 18 naira. The trade payable. So out of when we purchase this plant and machinery, probably we purchase it from trade. What do they call it? One of our trade payables. So because we purchased it from our trade payables, we didn't pay completely. So we are still owing 18,000 naira. So in other words, we bought 20 additional plant and machinery of 2,701, but the amount we pay is 18,000 naira less. So that is why we are subtracting it. It's like you saying that we bought 150 naira worth of goods, but you are not paying 100 naira. It still remains 15 naira balance. Excuse me. It still remains 15 naira balance. So the 15 naira balance means that money did not go out. So you find the differences. By the time you find the differences, you have this. Because the money goes out, this is the amount of the money that goes out, you are lessening it. Remember, once money goes out, you minus. Once money comes in, more money you add. So this is it. Now, when you issue shares from financial activity, it means that you are selling off shares. When you issue something, it means that you are selling. When you pay, it means that you are giving, your money is going out. When you issue, it means you are selling and money is coming in. So the question says that here's our equity again. Share capital, it was 2,794 before, but it increases. So the difference between this and this is our issue share capital of this 1,116 naira. The difference between this and this, because more money has come in. Let's look at our loan. Initially, you are owing 670, but now you've collected more loans. It means money have come in. So the difference between these two means that money has come in 1,106 naira. The difference between this and this. Preference shares. Look at this. Here, you have more, 838. Here, you have less. It means that your shares has reduced. So what then happens? It means that you buy more shares. Yeah, you pay for shares. You pay more shares. Yeah, that is you buy. So that is 400 naira. That is why you are lessing. That is why you are lessing. What again happens in your finance by? Did you have any information? Okay, in your retained earnings, so you have 179, and then this actually now, I'm coming, increase this to 112. Sorry, one. Hold on, sorry. Currents. So 179 minus 207 is actually 28. And do you have any news on maybe we paid any additional dividend, anything that did we pay anything? No. All right, dividend paid. So we have 179 plus 140 of your profits for the year. And at the end of the day, we are making 207 profits. So what then happens? It's saying that in the beginning of the year, you have, where is it again? In the beginning of the year, you have 179 as profits. You make profit of 140, remember. So 140 plus 179, your profit is supposed to be 319. But at the end of the day, your book is showing 207 naira. So what then happens to the remaining 319? So 319 means that you've actually spent 112 of dividend. You've actually spent 112 of dividend. The profit for the year was supposed to be 319. Your book's showing 207. It means you pay dividends of 112. So that's exactly what actually happened here. That we are subtracting. And at the end of the day, the whole cash that we have spent for the whole year, the whole cash that we spent for the whole year was 150. Both money coming in and money going out. But what is the cash that we have in the beginning of the year? Now, this is where the trick is. At the beginning of the year, the cash we have is 112. But is it really 112? Now, let's look at, we have a bank overdraft of 445. Do you know what bank overdraft is? Bank overdraft is when you are spending more than what you have. So in other words, you borrow a little change from the bank. maybe you want to pay goods of 150 naira, and you now pay, you have 100 naira in your bank account. So the remaining 15 naira, you can tell bank to just borrow you. So you will now pay 150,000 naira. The account balance will be showing negative of 15 naira. The negative of 15 naira is known as bank overdraft. So it's this. Then we now subtract, where is it? Cash and cash, 112 minus 145. The 112 minus 145 is what gives us 33 naira. That is cash and cash at the beginning of the day. So when you add this figure together, 33 plus 150, it gives you 183. Oh, this is it, 84. So 112 minus 115, 33. So at the end of the day, you have 183. Remember that at the closing balance of it, where is the closing balance? At the closing balance, you have 84. 84 minus 140 is 267. 84 minus 267, we have 183. So 183, 183. This means that your cash and cash equivalent is equals to your balance sheet cash. So basically, at the end of your calculation of your cash flow, it needs to rhyme with the cash and cash equivalents. Assuming we don't have a bank overdraft, for example, your answer should be ending in 84 naira. But then we have a bank overdraft. So that is why bank overdraft is still the same thing, is the extension of cash and cash equivalents. But here we are actually lessening it from your cash and cash equivalents. So that is all for cash flow statements. Please, I would love you to look at this again, to really treat it, and maybe by 5 o'clock tomorrow, if you still have time, you can just beep me, or I will beep you if you have any further question, because I can understand that Tuesday is your exam. So just try and look at it again, and if you have further question, you can just ask me. So we'll be ending the class for now. Thank you. Or if you have any question, actually, you can actually chat me up on WhatsApp right now. So if you do, so I'll be ending the class. Thank you very much.